Mr. Paul Chew, who will start sharing on the Singapore market strategy and stock pick. Mr. Paul Chew. Put hands together. Thank you.
Yeah, the last time a song was only my wedding. So anyway, thanks everyone. I will just share. Okay, I'll just share with. Also, thanks everyone for joining us today. I think again we do this every quarter, and thank you for spending your precious Saturday with us. The last time we did this was 3 months ago. So I guess I'm not sure if anything interesting has happened over the last 1-2 months. So our strategy for the second quarter is what to do in a fog. So as you can see from the picture, what we were trying to say was that in this fog of war, there's very little clarity, and when you're in a fog, you can't see what's ahead, and there's a risk of you falling down. So that's why we were actually very cautious. But of course, this was before the ceasefire. But we think with this ceasefire, we think it will hold, and we think probably the worst of the conflict, the risk from this conflict is probably over. And if you notice, there's a person mowing the lawn on your left or on your right. Not to be insensitive of it, but in Israel, they got this strategy called mowing the lawn. So every few years, they just bomb something. It's called cutting the grass. But again, this is not a very insensitive thing, so I didn't say anything. So okay, let's move on. Okay, so in terms of our disclaimer, as usual, this is for educational purposes. This is only our view, and feel free to seek advice from your financial advisor, because all the recommendations may or may not be suitable for you. This is the agenda. We will very quickly just start with how Singapore performed. And really, Singapore has really done really well. And then we will run through the macro. I'm not going to bore you with all this GDP, which tells you nothing anyway. But then the second part, my colleague Zain will talk about the technicals, some of his picks. And then, of course, as usual, we will always have a special session for banking and REITs, because it's such a huge part. For this quarter, we'll just talk about all the small caps, because we think that's where the momentum and there's much more growth ahead. And then we will just discuss our model portfolio. We'll start off with a review of what happened in the first quarter. So in the first quarter, what you see right now is all the big caps, the Straits Times Index, the large cap, the performers, the best performers for the quarter. And really, the Iran war really drove the returns. If you look on the the best gainers was defense, biofuels, and volatility. So defense, of course, I mean, if you're in Middle East right now, there's one thing you learn is you better learn how to defend yourself. And one thing good is that for whatever reason, one strength that we have is that actually Singapore, we built our own defense industry. We didn't outsource to Mr. A or C or whatever acronym you want to use, but we have our own defense. And right now, ST Engineering is actually exporting our defense capabilities. And that's because if you're a Middle Eastern country, if there's someone attacking you, you can't call you can't call US because they may just tell you not enough missiles. So you better build up your own defense. So that's why ST Engineering is doing really well. Because they are exporting all their capabilities and localizing for Middle Eastern countries. Having said that, I actually had a call at $4 to $8. Then I had a hold, and then it went to $10. Okay, hopefully nobody noticed that. But I did upgrade it, and then right now our target price is 13. So we are still bullish on ST Engineering, because we think there is a big structural tailwind, especially after this Iranian war. And they actually mentioned that their exports, defense exports, is going to triple. In over 2 years. So that's why we think ST is still positive. Biofuels has done well, because jet fuel prices just doubled, and then Indonesia said they want to raise their biodiesel mandate. SGX has done well. The volumes in March, I think, is up 70%. So hopefully this benefits the brokers like us and benefit the brokers' employees too. So the SDAV right now is 2.6 billion. 2 years ago, actually, it's only 1.2. So SGX usually only trades 1.2 billion. Right now, it's trading 2.6 billion. So you can see the whole re-rating of the whole SGX market, which is good, because when you have this kind of volatility, it gets more you attract more liquidity, attract more funds, more hedge funds when there's returns out there. Banks is still a safe haven. Banks may also be safer than REITs if you have expectations that inflation is going to rise. Because if inflation rises, then interest rates will rise. So that's why you can view it almost like a safe haven. And when risk rise, volatility rise, banks also benefit because there's more hedging activities and so forth. My colleague Glenn will touch on it more. And that's why, of course, then REITs didn't do so well, like Maple Tree Log. At least you are not, they are Maple Tree private fund student accommodation, that probably may have performed worse. But at least for this quarter, this was the worst performance. So REITs was sold down very poorly this quarter. My colleague Darren will talk more about it. And consumer has also performed poorly. And it is to be expected. Because emerging markets, like, if you're in Indonesia, if you're in Thailand, Philippines, with the hard surge in inflation, you will feel the pinch. So that's why we took out Singtel from our model portfolio, because Singtel is exposed to countries like India, Indonesia, Thailand. And in these emerging countries, mobile phone services, it's not like us now, every month, we don't even notice the bill, but in these countries, mobile phone spending has a discretionary, it's like something discretionary. If I can't spend so much, I won't top up the prepaid, and I won't use so much. So it's not to say Singtel is not good, just that we think that the growth may be a bit more sluggish for this kind of emerging markets. So in terms of Singapore, so Singapore has done, this US dollar returns so that you can have a fair comparison with the other asset classes. So Singapore has still managed to have a 5% return in the quarter. REITs, of course, suffered. Likewise for bonds. So anything that's interest rate sensitive, because now interest rates are not expected to be cut and might even rise. So that's why you see all this underperformance. We even beat Asia Pac ex Japan. So if you think about it, over the last 15 months, Singapore market is up 35% in US dollar terms, about 30% in Sing dollar terms, and this is excluding dividends. So if you exclude dividends, maybe in Sing dollar terms, you get 35% returns, and in US dollar terms, you get 40%. Sorry, this is not a history lesson, but just to make everyone excited, hopefully. Then Nasdaq has not done well, but Nasdaq, although we don't cover Singapore, do watch out for Nasdaq. Although this is Singapore pitch, but because there is a lot of IPOs coming out in the US in the second half, this may revitalize the whole Nasdaq market. You have the 1 trillion we have the 1 trillion Anthropic IPO. You have 1.5 trillion SpaceX, and the way they kind of play around with the index, there'll be a lot of money, passive flows going into all these IPOs, and then you got Anthropic. So that might actually be revitalized because when money goes into, and as you know, the US business model technology, it's not also the technology, it's not like the Tesla car is so great, but capital is a competitive edge. So do watch out for the whole tech sector. You might get this big revitalization. But I'll let my analyst, Glenn, we have another US session, so he will elaborate more. Gold and commodity, and these are just ETFs, so you actually can get all this performance in gold. So gold did like 70% in 15 months. So it has to consolidate. I mean, this thing can just keep on shooting like a rocket, unless it's SpaceX. Yeah. Okay, so this is my last slide on performance. So this is just on local currency terms. So if you look at it, Korea did well. Even though Korea was down 19% in March, it was still up 20%, mainly because of semiconductor has been really vibrant, especially memory. Underperformers have been emerging markets like what you mentioned, Indonesia, India, Vietnam, and so forth. But again, this is just like history lessons, so we're not here for that. Okay, so in terms of our macro view, so let me just explain why we were extremely worried of the equities market. So if you look at the red line, so the red line is oil prices, crude oil. So in the past, and the blue line is equities. So equities and crude don't really, equities can move, oil prices can move up or down. It doesn't really impact equities. This is the US equities. But you notice that once after the war happened, the shaded line, whenever oil price rose up, equities come down. So it became by default, you are like shorting. When you buy equities, you're shorting the oil price. Make it in simpler terms, if you buy equities, means you think oil price was coming down. So obviously with the conflict, we were of course extremely worried because the market really didn't price in that. And we were worried that oil price, there was a pathway for oil price to hit $200. Let me just explain. So these are all the various wars that we had. Kuwait war in blue line. Then the recent one is Iran. And the shaded part is when the war started, how did oil price behave? So if you look at the blue line, when the war started, when Iraq invaded Kuwait, oil prices went up from, $16, went up to 42. So if this war had continued, oil could have hit 200, because the reason why oil ran up so much in the Kuwait war was because Iraq and Kuwait was maybe 7% of oil then, and then there was worry Iraq would also attack Saudi Arabia, and then the whole of Middle East oil infrastructure would have been in paralysis. I'm not doing, again, another history lesson, but there were parallels to this current war, because the whole Middle East export could have been affected, and this could have driven oil price to 200, and that's why we were worried if oil price hit 200, then equities would have also kind of collapsed. But we think with this ceasefire, the risk is not there anymore. We think equities can start to recover. And of course, the other thing is, of course, recession. Every strategy, everyone will ask about recession. And so this is just the chart on recession is again shaded. The blue line is oil price, and the red line is interest rates. So it's not really oil price that actually causes the recession, but it is the medicine, because when inflation is high, the Fed will raise rates, and it tends to bring in recession, if you look at all those green little bars there. So that's why we don't see that now. I think it's still like neutral whether the Fed will raise rates. Just two more slides on this. We were not scared about just if oil prices went to 200. Sorry, this is not like to make everyone feel gloomy. This is not happening anyway. But this was the possible scenario, was that if the war extended, it would have been worse than the pandemic, because in the pandemic, if you ordered something, you may get it slower. You buy Lazada, like me, you have a VIP member. It might have been slower, but you still get it. But if this war happened, like in Singapore, there were already 3 chemical plants that were force majeure or technically shut. You cannot get production, you cannot get plastic materials, you cannot get textile, cannot get food, medical. So that could have shut down the whole industrial sector in this region especially. This is just a picture of the plastic prices that spiked up and fertilizer. Of course, we all know fertilizer, so we don't talk about that. But what I'm just trying to say is that there was that huge risk if this war really continued, because everything was starting to shut down. If you're into rubber gloves, which should be doing well right now, because all the rubber glove price went up from $17 to $30, because there's not enough raw materials. Everything's on allocation. So that's why there is repercussions. This chart, I'm actually scratching my head. That's not why I actually added in, maybe just to show that Gemini is impressive. But this is from a Gemini. So this is just to show that all the oil actually came from Middle East, the green lines, and then it goes to China. So if you are an Asian importing country right now, you will be worried because now that the Straits has been weaponized, so anytime Iran can just shut it down. So there's going to be a whole renewal of where all the energy shipments are going to go. And of course, you can call him a genius or not, then of course, US has done really well. They call Canada is also another major oil exporter, and he called Canada's his. So now he's got the biggest energy block, including Venezuela. Yeah, so what we're just saying, maybe this is good for this is more of a US dollar chart, but just to give you a sense of the impact of this war. And then what may happen is that, the US controls fertilizer. Because gas, fertilizers produced for gas. So US is not only just a big energy exporter, it's also a big fertilizer exporter. It can be agriculture. So there's a lot of geopolitical things happening right now, but I'm just giving you a flavor that there is a lot of repercussions because of this. Okay, but anyway, if there's one chart that is the most important, we think the major investment team globally, we call it bill. You can have 4 bills, 5 bills. I'm just making 3 bills. Okay, so the why we say that is that globally you're going to get this huge global capex cycle. Don't talk about Singapore. I mean, we drive around, we didn't know. Okay, but I didn't put it here because all of us drive around, so there's a lot of construction work. But globally, there's a big ramp in AI infrastructure. AI infrastructure, like capex, is up 260 billion. So this year alone, AI could jump 700 billion. And if you heard the news, like Anthropic's annualized revenue, so their Anthropic is like your ChatGPT, for those who may not know, but more for companies. Their revenue has jumped from 1 billion last year to 9 billion end of last year, and now it's 30 billion. So what it means is that they have the money, they're going to go IPO, they will raise more, and they will further ramp up this AI infrastructure. So this AI infrastructure team, be it in Malaysia or be it in US, has a lot of legs to go. And the latest LLM, I'm going a bit too much, this is not a tech conference, but if you look at the latest ChatGPT order, these are from the older chips. And then now, because NVIDIA came out with the new chip, so the LLM is even becoming even more powerful. And like you mentioned, if you saw the news, Anthropics, I just forgot the name, Mythos. So they had this Mythos LLM that they actually didn't want to release to the public because they said that this software could actually hack everyone's software because it could see thousands of vulnerabilities. But anyway, another optimistic point here. So for semiconductors, it's also going to be a big ramp here, equipment spending. So we are actually very bullish on all the semiconductor stocks. We only cover one, but anyway, we are bullish across because equipment spending is going to be strong. For AI infrastructure, some of the winners will be, of course, CSE Global, even TeleChoice, they mentioned they're going to build something in Malaysia. Defense is, of course, even before the war, NATO also had to raise their defense budget. So you can imagine now if you're someone like Japan, you've seen the war, what are you going to say? You're going to say, oh, I can rely on the US, they're going to still protect me. Something. So we think there's going to be a big ramp up in defense spending globally. Energy, of course, renewable spending could be resurrected, like what we see in Oiltek's sustainable aviation fuel oil, because energy is no longer become a national security agenda because you can get shut out. That means your country can run out of fuel. So then you have to focus more on building renewable, your own source of energy. So this will also cause a big boom in infrastructure. And finally, of course, Middle East, there is a rebuilding, you can come up with any estimates. But the key message you want to just say is that this build will be a major team to help a lot of corporates, and anyone riding on these teams will be a big beneficiary. Just two more last slides for me. This is just to promote Singapore. So Singapore, since we are here, so Singapore has one of the highest reserves. Not reading a script here, but including, so if you look at this chart here, is basically Singapore's international reserves. So on paper, we have 400 over billion. But if you notice, there's this red line that we are always sure because about 200 over billion, we passed it on to GIC. Here, take it. Some of it came to us in EQDP. Not much, but anyway. But if you added that back, our reserves would have been almost one of the highest in the world, like the 5th highest. So there's a lot of liquidity, and this is up to February, so we're not sure much because of this conflict. There could be even more liquidity coming in. And that's why interest rates in Singapore actually didn't rise. It actually came down despite what is happening around the world. Just one last slide on my macro before I hand it over to my colleague is that Singapore exports is doing exceptionally well. Our exports are up 66% in the first 2 quarters. So the economic situation in Singapore is very robust, especially if you're in exports. And then semiconductors are up 66, exports are up 50%. And it's not only just us, exports in Korea is up about 48%, the highest in 40 or 50 years. So it's a very vibrant, it's all driven by semiconductor exports. So what I just want to get the message for everyone is that Singapore has the liquidity and the economic conditions are very strong here. Anyway, we're already here, so there's nothing much you can do. Okay, I'll anyway hand it over to Zain, my colleague. He will run through the technicals, and then I'll come back later on some of the small cap names. Yeah.
Okay, thanks, Paul. I'm Zain. Good afternoon, everyone. So I'll share the technical outlook for the Singapore market and also some stock picks we have just by looking at the charts. So it still remains very resilient. So you can see from the picture, the investor actually looks pretty relaxed while still keeping updated on the news about the Iran war. So first up, I'll share about the outlook of the Singapore benchmark. So looking at this ES3 ETF, that's the stock code that tracks the Singapore benchmark. First quarter, it was a bit of a sideways consolidation, but there were higher lows being formed. So most of the gains actually came in January, while February to March was a bit more sideways. But it still performed very well. It was up for the 8th consecutive quarter in first quarter, so up 5.2%. Yeah, so in terms of the chart, there was a bit of sideways consolidation, but it's still holding the very important upward support line. So it's this black line you see in the chart, sloping upwards since August last year. And also on the weekly time frame is the 20 SMA level as well. And recently, price also recovered back above the 5 and 10 SMAs on the weekly chart as well. So that's, I think, some momentum coming back. And should the price break above the $5.05 key resistance level, we do see further upside ahead for the Singapore benchmark to hit about $5.39. So that's about 7% upside from the current levels. Next one, I will share about all of the next 50. So the next 50 are the next 50 is actually the index that actually tracks the next largest 50 companies outside of the top 30 in the benchmark. So in terms of the chart, it's still performing quite well. There was a bit of recovery after a pullback since the Iran war started. First quarter was down slightly, about 0.6% after 2 consecutive quarters of gains in the last 2 quarters last year. In terms of the chart, it's still holding at the 1,400 key support level, despite the sell down we saw in the start of March. Price has since recovered to recover above the 1,480 level this week, and some of the short-term moving averages as well. So we do see the momentum coming back after this slight pullback, and we do see the uptrend to actually continue to hit potentially the 1,570 level. So that's about a 4% upside from the current levels. So in terms of our stock picks, first one we have, in terms of the large caps, we have Sembcorp Industries. So we think in terms of the chart, it looks more promising now. Where price broke out of this downtrend, it was trading in since August last year. And yeah, in the end of March, there was a breakout of this downtrend channel. Coupled with the expansion of the Bollinger Bands, so we think that price has actually came out of this pullback recently, and some volatility expansion to actually transit from the downtrend to back to the bullish momentum. So we see that potential target that will hit in the second quarter is the $7.81 level, 13.3% upside as of from yesterday's close, to actually retest the highs that we've seen in August last year. And next one for mid-cap pick, we think the chart for Yangzijiang Maritime development actually looks quite good. So in terms of the chart, we do see a bullish reversal. So price was previously was trending downwards since December last year, and then but we see some signs of a bullish recovery, especially this week when price recovered back above this 56 cents level. So this was a support level that there was a breakdown in February, and there was a bit of recovery this week, coupled with a breakout of this downwards resistance line in from February as well. So I think it looks good to actually stage a bullish recovery upwards and potentially retest the 72 cents previous high that was back in December last year. So that will make about 15% upside from yesterday's close. Yeah, so that's all for me from the technicals. I'll hand over time to my colleague Glenn, who will share more about the Singapore banking sector. Thanks.
Hey, thanks, Zane. Yep, hi everyone. So I'm Glenn. Cover the banking sector. So so just basically this chart here is just showing, the higher for longer rate environment is beneficial for the banks, right? Basically on the left, I'm not sure if it's a bit small, but you can see that that's the Middle East Iran conflict, and it reflects into higher inflation and then higher rates as rates are kept higher, and then this will be beneficial for the 3 Singapore banks. And I'll be going into detail into why we believe that this will be so. Yeah, so we just do a very quick recap of the fourth quarter results. It was fee income that really drove earnings, or actually helped to prop earnings. You can see across the board, it was all double-digit fee income growth. Right, it came a lot from the continued growth in AUM as well as in the continued fee income growth. So this helped to boost the fee income. if you look at the top one, I didn't highlight it there, but you can see that the lower rates have hurt the bank's margins, right? You can see it's down by close to almost 20 plus basis points across the board for all three banks. And then this also resulted in the lower net interest income, which is still the main contributor for the banks. And I'd like to highlight, you look at the PATME, there's one single red box there, and that is the outlier, which is OCBC. So I think a lot of questions have been asked to me is like, why is OCBC doing so well? That is one of the main reasons, is that they were able to offset a lot of their decline in net interest income from fee income, which is why we saw a very slight increase. But if you compare it to their peers, they were doing better. That's what I'd like to highlight. And of course, dividends for FY26, dividends are still very healthy, around 5% for all the banks. DBS is still the highest, right? Because they have the fixed dividend per share, and then they're also not scared to go past the dividend payout ratio of 50%, unlike the other two banks. But I'll go into more detail into this when I reach the DBS slide. Sorry. Yeah, so we always have this slide, showing that margins, how does margins correlate with the interest rates? So you can see that there's always this quite usual, there's a correlation, it's quite strong, right? Whenever rates are down in either both the US or Singapore, then we'll see margins follow suit. But recently what we have been seeing is that there's a bit of a divergence, right? So you can see that rates have been continuously going down, but in the last quarter, we saw a quarter-on-quarter uptick in margins. And why is this so? It's because the banks have finally come in to cut their deposit costs. So you will probably be affected by this. If you have noticed your one account, 360 account from OCBC, they have all been cut and slashed quite a lot. And that's how the banks are saving money. So, if you earn less from there, but at least, the banks are earning more. So if you place you have shares in the banks, then, you can at least earn back from the bank's shares. Yeah. So that's a very positive way for us to look at it, because, even though rates are still very low, we are actually seeing an improvement in margins. So this shows that the banks are controlling their cost of funds. And now that we are sort of, looking at not much rate cuts or even no rate cuts for the rest of the year and some stabilization in Singapore interest rates, then this is a very positive sign. So we could see a further uptick in the bank's margins. I highlighted this box here. So that's our forecast for 2026. We are expecting it for the bank's margins to come in at around 1.77%. That's a 17 basis points decline. So this is on the lower end of what the banks are guiding, and also what we are expecting. If we see rates really hold, and more importantly Singapore interest rates hold, I think we can push that up. So the decline could be smaller than this 17 basis points, and even maybe a single digit sort of decline, and that would be very beneficial for the banks. I spoke earlier, about how the banks have managed to maintain their margins, and one of that is from deposit growth. So apart from, of course, cutting your interest rates from your accounts, another way that they are earning is by growing the whole base. So the rates is just one way, right? They are the spread. Then the other way is that their base is actually growing quite well. And we can see that, it has continued, even though it has decelerated, but February figures show us, it's up by 5%, and it has been growing very steadily. So this is one of the ways that they are also helping to make sure that their margins are kept still at a relatively high level. And more importantly would be the current account and savings account ratio. So this translates, to your one account, 360 or multiplier accounts. This is essentially the, like free money for the banks. So they pay very little, right? Although, the headline numbers are like, they're paying 4 or 5%. But if you look at it, if you look at the base interest, I think they're only paying 0.05% per annum. So this is essentially free money for them. So with loans growth also growing, they are lending out whatever they're getting in their current accounts, and that's how they're earning the spread. Why we believe that the CASA has been growing is because, maybe if you put it into a fixed deposit a year or 2 years ago, where you can get, 4%, and then now currently, fixed deposits, if you're lucky, you can get 1+%. So you'll say, let's wait and see. So you just park it where? Into your current account, savings account. And that's, that's where the banks can actually make that money, because we are seeing that CASA ratio, which is the ratio to their deposits, is currently at 20%, and that's the highest we have seen in 3 years. So the higher the ratio, the more beneficial it is for the bank's cost of funds, which is their cost, and then this will help to improve their margins further. And I think going ahead, we will probably see that continuing, right? If it won't increase, at least you'll maintain at this 20% plus level in the near future, because rates are not going anywhere, especially for Singapore. Yeah, and also loans growth. So, if they can't improve their spread, right, the only thing they can do is to improve the base. And that's one of the ways that they are going about doing it, is by growing the loans. And loans growth has been quite healthy, mainly from the low rates that we have seen in Singapore. So this loans growth chart here is for those for Singapore loans, right? It's growing at 6.3%, and for the last almost 9 months, it has been above this 6% figure. And what we are seeing is very broad-based kind of loans growth. It's across both business, consumer, housing loans, building and construction loans. So it's really quite broad-based. There's not one specific sector where there's a surge in loans. And the banks are still guiding, I think they are being relatively prudent, right? They're still guiding for mid-single-digit loans growth for the whole of this year. And I think UOB is also, pushed it down a bit from low to mid-single, right? So I think they're being a bit safe. I believe that we could possibly go above this mid-single digit come year end, especially when the rates are still very low. Yeah, so we also get quite a lot of questions on how does the Middle East and the Iran conflict impact the Singapore banks. I would say, based on the data that we have gone through and what we have analyzed, I think it's quite safe to say that they are very minimally exposed to the Middle East. So they do not have any direct exposure, right, to the Middle East conflict or the Iran conflict. But what we can see is that the transport sector, communication sector, which is where the oil and gas loans are parked in, but there's no exact figure of how much is this oil and gas loans. It only makes up around 7% of the total loans. So it's still relatively small. And the biggest worry is that, whether or not the NPL ratio will actually increase for this. But you can see that it's actually very low. UOB and OCBC is around 0.3 to 0.2% NPL ratio. And DBS is slightly higher at 2%. But if you look at a year-on-year basis, it has improved from 2.7 to 2%. So it's still improving the NPL ratio, is very low and very benign. So we don't believe that, this sector will impact the banks a lot. And another sector that we look at, in terms of this conflict is the ASEAN loans growth. So that's what we use to measure the emerging markets risk. I think Paul spoke about it earlier a little bit. The loans growth has averaged low to mid-single digit for the ASEAN loans growth. This is slower than the total loans growth pace. So it's not like they're over-lending to the emerging market sector. So we don't believe that there will be a lot of impact from the Middle East conflict, at least on the Singapore banks. Yeah, so we go to our two picks for the banks. We have DBS and OCBC. Those two are our top picks. DBS, I think I've been saying this for quite a while, but it's really the only Singapore bank with no payout cap. So what I mean by that, I mean to say that they don't have a dividend payout ratio cap. If you look at the other two banks like OCBC and UOB, they are very strict with their dividend payout ratio. So they will say, I'm only going to pay out 50% of my earnings. But with DBS, they will look at their capital, their excess capital, and then they'll say, okay, we are okay to pay more. And we can see that, you look at this chart here, the blue line, it's basically showing the orange bar is showing the dividend payout ratio for DBS. You look at 2025, it was close to 80%. So they're paying out 80% of their earnings. But not to be worried, if whether or not they are paying out too much, a lot of it comes from their excess capital. So they still have a lot of excess capital and they are giving it back to the investors and shareholders. So for 2026 and 2027, we expect that they will continue to pay out as well, and they have committed to it. So we expect that they also have this. So apart from paying out excess, the capital returns, they are also giving ordinary dividend step up. And we can see that I think they confirmed it all the way until the third quarter of this year. So we believe that they will still be able to do this 24 cents ordinary step up all the way until 2027. So we are expecting FY27 dividend yield of around 6.1%. And then for FY26, based on the current share price, it's around 5.7%. So we have an accumulate call with a target price of $60 for DBS. Yeah, so for OCBC, why we like OCBC is because of their highest fee income growth, and I also did speak about it earlier a bit. I say that, their PATMI is also the only one that showed growth in the fourth quarter. And I think in the first quarter, we hopefully can see that again, right? We are seeing fee income growth highest, so they are able to really push their AUM base and also grow the fee income. And I think more importantly is also the excess capital that they have. They currently, unlike UOB, they are putting a lot of their excess capital into the provisions. We saw that in the third quarter, they put almost 600 plus million into provisions so that they can boost their coverage. And then DBS is, have already said that they'll return it. But if OCBC is a bit like a question mark, right? Are they going to give back? The good thing is that they didn't say no. But they didn't say yes. So we're really not sure. And that is some upside surprise, and potential that we could see an increase in dividends, and hopefully they will bump their 50% payout ratio to at least 60%. Otherwise, their current CT1, which is what we use to measure the excess capital, is at 15%, which is 1% higher than the optimal, which is 14%. So we are looking at around $2 or $3 billion worth of capital that they have no idea what they want to do with, right? The only way they can spend it is acquisitions or giving back in dividends. So hopefully they'll give back in dividends, and then every shareholder will be happy. Yeah, and I think more importantly also for the last quarter, and I think what boosted their share price was that the new CEO did say that they are leaning more towards giving special dividends. So that gives a lot of positivity to investors and shareholders, because I think that's the first time I've heard them say it in almost like 4 or 5 years, right? At least the old CEO didn't say anything, so this new CEO said. So based on they have around $700 million worth of share buybacks that they have to do left for this year. So we are assuming there's 500 million left, right? And they cannot buy back any more shares because the share price is too high. They will give it back in special dividends. And we are looking at around 11 cents per share in terms of that special dividend for the remaining of that capital that they have yet to return. Right? So that's already one. And then hopefully if they continue to give back more capital, we could see even higher dividends. So that's one of the reasons why we like it. Yeah, you can see that our target price is $21.50, and we have a rating of neutral. So it's we really have to see some more good news. So hopefully in the next results earning, if they can maintain their fee income growth and their PATMI growth, and also control their margin compression, their net interest margin compression, then that would be some re-rating catalyst for us to maybe increase or look at the target price again. Yeah. So before I get any questions on why my target price is so low. Yeah, so for the conclusion for the banks, I'll just go through this very quickly, right? We saw that fourth quarter earnings did dip slightly from the lower margins and also their net interest income, but then again, we saw net margins sort of stabilize quarter on quarter, and that's a very positive sign. And we also seen that fee income and loans growth have helped to partially offset this net interest decline, and that the bank with the highest fee income growth can actually show some improvement in their bottom line, which is their PATMI. We also don't believe that the Middle East conflict will really impact the banks much. If anything, it will be a positive for the banks because of how it has pushed back the rate cuts. And we are projecting that FY26 earnings will grow by around 7% for the banks, which will be led by fee income and loans growth. So we do like DBS and OCBC for the reasons that I've mentioned a few minutes ago. Yeah, so apart from banking sector, I also now cover the Maritime. So we have initiated coverage of Yangzijiang Maritime. I think we are the first in the market to do that. It's a very interesting company. It's a bit confusing, I guess, for anyone who's not really in the industry or the sector. So I will just go through very quickly, what is the business model, and how does the company make money. So just some brief background, Yangzijiang Maritime is not a bank, it's not a shipbuilder, it's really just a platform that they raise and deploy capital, into shipping assets. So the three ways that they earn money, if you look here, you can see that there is the investments which make up around 40 to 45%, and the returns that they get are really from capital gains and charter income. And then financing is the other big bulk, which is very similar, also 40 to 45%, and it's really coming from recurring lease interest. And last but not least, they have the value-added services, which is around 10 to 20%, and this is from the chartering margin spread. And one of the very impressive things for Yangzijiang Maritime is that they have they capture every stage of the vessel life cycle. So it's not just one stage. Let's say when you sell the thing, when you sell the vessel, that's how you make money. So they get it from the first stage, which is the new build. So that's where they get the procurement margin, and then the delivery, and that's where they will see the asset on the balance sheet at cost, and then also operations, then financing, and also at the exit where they will get capital gains. So they really go through almost the whole life cycle of the vessel, and that's very impressive for a company, and which is why one of the main reasons why we like it. Yeah, so the 3 investment merits for Yangzijiang Maritime and why we like it and why we have initiated coverage with a buy call and a target price of 69 cents is, the first one is, I was speaking about it earlier, is that their full life cycle capture across all vessel types. So it's not just one, like one oil tanker. They do all different kinds of vessels, and they currently have around 80 plus vessels in their fleet, and also up to 50 new builds in the pipeline. The second one is the shipping upcycle. So the Iran and Middle East conflict has pushed up the vessel prices. So we are seeing we use the Baltic Index, it's up by 22% year on year at around 2,000. So this will actually help to boost the fund that they have, which is around 1.3 billion across with 50. They also have 50 more new vessel new building in the pipeline. And we can also see them that they're moving. They used to be just a pure cash management, right, where they just do, they put it into like a treasury or fixed deposit and they earn that small spread. So now they're putting a lot of their cash into this maritime fund. So we are seeing the spread will increase quite drastically moving forward. And last but not least, they also have a net cash balance sheet at 27% of market cap. So they have around $400 million US dollars of cash, and if you translate that to Sing dollars, around 507 million, and that makes up about 27% of their market cap. They currently do not use any borrowings, or there's zero leverage. So if they do introduce leverage, which it was hinted at by the senior management, and this could help to boost their IRRs from the current 10 to 15% to 20 to 30%. So we do initiate coverage on Yangzijiang Maritime with a target price of 69 cents. And this target price is tagged to 1 times price over book, which is about 10 to 11% above their peer valuations. But because of the reasons I have mentioned earlier, this is why we believe that they do deserve this 10% premium. Yep. So that's all I have for my time. I'll now hand it over to Darren, who will cover the REITs. Thank you.
Yeah, thanks, Glenn. Yeah, hi everyone. I'm Darren, and I cover REITs and property. Yeah, so for us, our positioning now for REITs is that basically because of stagflation, we're expecting growth to slow, and that might impact tenants' profitability. And as a result, the positive rent reversions upcoming, the potential for that might not be that high, as well as the fact that with possible inflation increasing, we also expect the central banks to kind of keep rates elevated or even hike interest rates. But as of now, the market's still pricing in flattish or rather no rate hikes or no rate cuts this year. So if interest rates remains high, so that will also impact REITs. But for this picture specifically, we see that REITs are generally considered as a safe haven asset, but REIT investors recently, over the past year to date, is down 8%. So the investors are nervous, and even though it's considered a safe haven, they're still nervous, waiting for possible uncertainty that's upcoming. Yeah, so first of all, this chart, it shows the S-REITs index versus the oil price. So everyone is now paying attention to the rise or the spike in oil prices. So this is just a correlation, or rather we plot it against the S-REITs index, and we see that actually there is really no correlation with oil for the S-REITs index prices. So generally there is is a more indirect relationship than a correlation. So it's generally based on higher oil prices. Generally it will lead to higher inflation, and like I mentioned, as a result, central banks will likely keep rates elevated or even hike, and that will impact S-REITs earnings. So basically, there are 4 main reasons why S-REITs don't perform well in a high interest rate environment. So first of all, it's definitely because just a pure funding, like they have to pay higher interest expenses, or finance costs, and as a result, that will really impact their DPU or distributable income. So the distributions you get as investors will decline. So that is one. Another one is also property valuations. As interest rates increase or remain elevated, there is higher possibility of cap rate expansion as well. So that will really impact property valuations. And also the dividend yield spread with higher interest rates, the yield or the risk-free rate or the bonds will also likely increase. So that will impact the dividend yield spread you get, like the dividend yield over the risk-free rate will decline, will narrow. As well as the fact that with higher interest rates and generally more uncertainty in the market, transactions volume also will likely decrease. So we saw last year there were many acquisitions and divestments and a lot of capital recycling that was done from a lot of the S REITs, and even it flowed through into the first quarter of this year as well. So going forward with a lot of uncertainty, macro uncertainty and potential high interest rates, we think this momentum will slow down, and as a result, we think there will be fewer acquisitions upcoming this year. Yeah, and so how generally Singapore is now impacted by high electricity prices, as well as most of the electricity Singapore generates from LNG, which is also tagged to oil prices. Also, or rather linked to oil prices. So if higher oil prices, electricity will also rise. So how rising utility costs will impact S REITs is very different for a lot of different sectors. But generally across the board, most S REITs, they either hedge their utility exposure or they can pass it through to their tenants through a service cost or just a direct pass-through contracts. Yeah, so for us, we think the sector that will be most impacted by rising electricity costs or utility costs, that will be the hospitality subsector, mainly because you can increase your average daily room rates, but you can't increase it that much as overall consumers are kind of price sensitive. So if you increase the prices too high, then if you will, your occupancy might drop. So you can't really increase that. But generally, a lot of the hospitality players that we know, they also hedge their exposure. And the next subsector that we think might be impacted also will be retail, because generally, because of under the fair tenancy framework, the code of conduct, you can't really pass the increase in electricity costs directly to your tenants. So usually the landlords will have to bear the higher costs. So, but then again, they also hedge. A lot of landlords, they also hedge this exposure, so the impact will not be that great. After all, for a lot of these retail and commercial players as well, their utility expenses roughly account for about 10% of their OPEX. Yeah, so it's still not as significant, the impact to their DPU. Yeah, so other sectors like commercial and like data centers and such, most of the time, the electricity costs can be passed on to tenants, so the impact is not that great. So yeah, for high electricity costs, generally hospitality sector will be most impacted from that, and retail as well. Yeah, so next we are looking at the price to NAV chart. So this year, the first quarter, we saw the S REITs index generally was down 8%. So the market is really pricing in a lot of this uncertainty, like higher interest rates and potential rate hikes as well. So as a result, we see that the price to NAV declined to about 0.9 times. So over the history of or rather the 10-year historical chart, we see around these levels at 0.9 times. That is usually around the bottom of where S REITs will trade before it actually rebounds. So that is this for the 2016 time and the time during COVID, that was around 0.9 times before it rebounded. But from 2022 to 2025, that was trading around 0.8 times, but that's mainly because of the huge de-rating, which reflects the interest rate hikes from the fact that before the rate hike cycle in 2022, from 2020, we saw like interest rates were like 0. So from 0 to like 5%, there was a huge rise in interest rates. So that was a huge de-rating in a lot of the S REITs. Yeah, but going forward, interest rates still remain kind of flattish at 3-month SORA. Has already declined, but it's really decelerating. So S REITs, we still expect them to still benefit from lower interest rates as well. Yeah, I have that in the following slide. Yeah, so like I mentioned in the previous slide also, so generally the rate hikes, because of higher interest rates, that will really impact the portfolio valuations and possible cap rate expansion. So this impacted the REITs that are most impacted are usually the overseas REITs, as over the past few years, even in a rate hike cycle and rising interest rates, a lot of Singapore, or rather most Singapore assets like commercial and retail, both also saw their cap rates stable. They didn't expand, unlike a lot of other overseas assets where we saw cap rate expansion. So that's mainly because Singapore is still seen as a very stable and property market where there's also limited supply, and also the operations are very stable and improving operations. So as a result, the cap rates didn't really move. Yeah, and property valuations remain very stable in Singapore. Yeah, so this is a chart I was talking about. So this is the S-REITs index plotted against the interest rates. So you see the Fed funds rates as well as the 3-month SORA. So 3-month SORA is generally the base rate that a lot of S-REITs use for their Singapore dollar-denominated loans. So the 3-month SORA really continues to decline. And as of now, it's about 110 basis points. So that's compared to about 300 over like a few years back, like from 2024. So going forward, we expect a lot of S-REITs as they refinance their loans this year and next year to potentially benefit from about 200 over or over 200 basis points worth of interest cost savings or refinancing spreads. As the rates you can see for 3-month SORA and now it's already declined by over 200 basis points. So we are expecting a lot of S-REITs to continue to benefit from more interest cost savings. And with the added geopolitical uncertainty going forward, we also think a lot of S-REITs will start increasing their percentage of loans that are on hedged rates or hedged or fixed rates. So currently, it's about the whole index, about 72% of their index is hedged to, of their loan is hedged to fixed rates. But going forward, we think that that amount will continue to increase. So a lot of the REITs will because of that, they'll start to hedge, and yeah, we think it's safe, a safer bet for them. Yeah, so next is the dividend yield spread. So what this chart it shows is basically the S-REIT's dividend yield minus the 10-year Singapore government bond yield. So it's basically how much investors are being compensated by investing in the risky asset REITs versus a risk-free rate or your risk-free bond. So now it's trading around 4%. We think at these levels it's still relatively attractive, given the fact that it has been increasing over the past few years. And but for DPU growth perspective, previously before all this uncertainty, like before the war and such, we were expecting at the start of the year for this year to have at least about a 3 to 4% DPU percent growth year on year, mainly because of lower interest rates and the fact that operating conditions remain stable. But now because of the fact that there's rising utility costs, so operating expenses likely to increase, as well as the fact that interest rates also will likely take a longer time to come down. So we're expecting a lower DPU growth of 2.5%, but at least we're still expecting DPU growth this year. Yeah, and since the 10-year dividend yield spread is trading around 4% and around historical levels, it is still a relative attractive yield instrument as compared to other yield, like your 10-year risk-free rate or your bonds. Yeah, so generally for REITs, we are neutral, basically because of like stagflation, like we mentioned earlier, but we favor those with a strong balance sheet, especially those with a healthy aggregate leverage ratio, like a ratio of below 40, we think that is healthy, as well as a higher percentage of their loans book that are hedged to fixed rate due to this uncertainty of interest rate, so that we think that is a safer play. Yeah, so moving on to our stock picks for REITs. First of all, we have Stoneweg Europe Stapled Trust. So this Stoneweg, they have over 90 properties in Europe. So their portfolio occupancy throughout COVID, throughout the Ukraine war, has been relatively stable at 92%, or rather around 90 to 95%, but currently it's at 92%. So, and they also indicated at their FY25 results briefing that they are indicating stable DPU in 2026, despite a lot of the investments that they made over the last year. And more recent developments for them is that they had an additional 50 million investment in Ionics, which is their sponsors data center development platform. They invested that through a mandatory convertible loan. So this 50 million can be, or rather will be converted to equity after 7 years or earlier at a significant discount. So in the meantime, they're getting a 7.25% coupon. And when they do convert this to equity, basically they will have a lot of NAV upside, and this adds on to the original 50 million investment that they made last year. So basically there's a lot of NAV upside potential for Stoneweg Euro Stippled Trust for now. And currently their loan book is 94% hedged, so it's very safe. They're kind of shielded from any potential rate hikes. And also they're hedged until end 2027, so that's about 2 years. And they do not have any debt due until 2030, so that is basically they do not have any refinancing till then. And the huge positive for them now is, right now, in light of the fact that inflation is coming back because of, or rather the higher inflation, their leases are CPI linked. So generally every year when they review their leases, this is the base escalation. Is CPI rental index. So basically the rents will increase based on CPI for a lot of their properties, or rather the majority of the properties. So they'll benefit from higher rental escalations from increase in any inflation. Yeah, and that really will help them generate the positive, or rather the increase in rents going forward in an inflationary environment. Yeah, so currently after the share price kind of retracted a little bit, so now they're trading at about 9% yield, so we think that is a very attractive play considering the fact that it is trading at such a high yield of 9% and also a lot of potential of NAV upside. Yeah, and next, our other stock pick we have today is Prime US REIT. So this is on the fact that we believe there is a lot they have a strong cash flow visibility from the fact that they have a lot of leases signed over the past year that have yet to contribute cash. So currently 10.6% of their occupancy has yet to commence any cash distribution. So that is based on the occupancy of 82.7%. So basically only roughly slightly upwards of 70% of their portfolio is contributing cash. So as this 10.6% continues, or rather as is staggered to contribute cash going forward, the DPU will likely increase, and also their payout ratio will also likely increase as they kind of lease up their portfolio. So they also recently just signed another 64,000 square foot of space, so that's about 1.5% of the NLA. So occupancy is on track to reach about 85% at least by end of 2026. Yeah, and currently we think that Prime US REIT, they are trading at about 7% FY26 yield based on the 65% payout ratio. We think there is a lot of potential for this yield to really increase as they increase their payout ratio going forward from the visibility of their cash flows. And a huge factor that we think Prime US REIT is a value play is because it's trading at a steep discount. Right now it's only at 33 times price to NAV, so there's a lot of upside potential for Prime US REIT. Yeah, and next I will just move on to the property sector. So the property sector in Singapore has been performing very strong, especially last year and the first quarter of this year. So last year there were about 11,400 launches, and the take-up rate was also very strong. So this year in the first quarter, we saw Pioneer Residences and River Modern also had some strong take-up rate of over 90%. And for the pipeline of assets excluding ECs, we are looking at about 8,000 units to be launched, or some already launched. So we think the take-up rates also might likely stay strong. Yeah, but for property companies, because of what's going on in the world right now, like the war and such, we think that the capital recycling might be a little slower than originally anticipated. Like a lot of property companies, they came out and they started monetizing assets starting last year. So we think that might slow down this year because of that, of what's going on around the world. Yeah, so that's all for me now. I hand over the time now to Iqbal to talk about small mid caps. Thanks.
Hi, good afternoon, everyone. I'm Ben. I cover construction and semiconductor. Yeah, so I'll be kicking off the small mid-cap segment. So as you can see in the picture over here, currently under the Middle East conflict, the uncertain situation, if you are bullish in the stock market itself, you may be able to find some gems in the grass fields, as you can see. Yeah, so this is what the picture is trying to illustrate. Yeah, so the title is also opportunities, trying to find opportunities in this period of uncertainty. Yeah, so for our first counter, we will be talking about Frencken. So for those who are unsure, Frencken supplies critical components used in semiconductor equipment players. So their customers are the biggest semiconductor equipment players within the lithography space. So this customer is from Netherlands. I think many of you can guess. The other customer they have is an American semiconductor equipment company in the deposition and etch, in the deposition and etching space. Yeah, so both of these are very big semiconductor equipment companies. And as you can see, at the blue color line itself represents the revenue trends of the semiconductor equipment companies, which is basically Frencken's customers. And the red color line represents the revenue of Frencken's, the revenue trend of Frencken itself. And as you can see, over the past few years, it's been closely correlated. There's a bit of a lag from the blue line to the red color line from about 2015 to 2019. That's because as the semiconductor equipment goes into volume manufacturing and delivery itself, there's a bit of time lag needed for the revenue to flow through to Frencken itself. Yeah, so for the most recent quarter itself, fourth quarter 2025, there's a bit of a dip in terms of revenue for Frencken itself. This is because their main customers have taken in their components during the testing phase, and now they are preparing for the volume manufacturing at the second half of this year itself. And we do think that the ramp will begin second half of this year, and we think that will flow through to Frencken either second half of this year or the start of next year itself. And the major theme for this ramp is also touched on a bit by Paul just now. Just now he mentioned that there's a lot of new AI model competitors coming into this space. There's a lot more demand for chip makers in order to produce these advanced chips needed to support all these AI workloads. So that's why TSMC has also increased their capex guidance by 30% for this year, and also from memory players as well. Memory players like Micron, SK Hynix, they are increasing their capex guidance this year in order to buy up EUV machines to save clean room space, because currently there is a shortage in the memory space. Yeah, so that's why we do think that these are big tailwinds for Frencken itself. Yeah, so touching on the next small mid-cap stock is WeHer. So WeHer is in the construction, worker dormitory, as well as PBSA and also property development space. So there's a lot of segments, but let me try to simplify it for you. This is our sum of the parts model. Sorry, there's a lot of numbers, but I think you can just focus on the most right column itself. As you can see, the biggest component within our model itself is the building construction as well as the worker dormitory space. Because for building construction itself, their order book spiked up by more than 2 times over the last year because they won 2 HDB BTO contracts. And this will support their recurring revenue and PATMI over the next 4 years as they build up the BTOs. For worker dormitory itself, they have an increase of 67% of worker dormitory beds because Pioneer Lodge, which is their new worker dormitory, has 11,000 beds, and this has they have just achieved TOP last year. So this year we will expect this dormitory to slowly ramp up in occupancy itself. As for their property development and fund management space, currently it is not very obvious in their books itself. It may not be reflected in their book value per share, but we value their monetizable assets at about $434 million. So this is about 73% of their market cap, whereby if they were to sell, for example, one of their funds itself, they are able to give back to shareholders in the form of special dividends, like what happened in last year itself when they sell off Fund 1 and they gave shareholders in the form of special dividends. Yeah, so this is the kind of catalyst we see which may drive the potential re-rating for WeHer. But it may not come that soon. Yeah, so for example, for the Upper Thomson GLS, it takes about from now till 2029 to build, because they have just been awarded a piece of land. So it needs time for them to build up the property before they can sell the property units off. Yeah. Currently for WeHer, we have a buy and target price 1.08. Okay, let's move on to Everglory. So Everglory, for those who are unsure, they are the biggest M&E player within the construction space itself. So M&E refers to mechanical and electrical. And over here in this table itself, it shows the overall construction contracts we can expect coming out this year. So the project value at the most right-hand corner represents the total value of the construction projects. So it's not just M&E value. So we are talking about the whole project itself. For example, Terminal 5, we expect it to be $18 billion. And we expect this kind of value to flow through to Everglory, because after acquiring Guthrie back in June last year itself, Everglory is able to secure higher value M&E projects. For example, Guthrie, over the past few years, Guthrie has been servicing and maintaining Changi Airport runway lights. And this runway light is a very critical component in the airport space, because the runway lights cannot fail. If the runway lights fail, the planes cannot land. Yeah, so this is why we think that track record is very important in Changi Airport Terminal 5 contracts. And we think that Everglory is able to secure Terminal 5 M&E contracts going forward. Touching on the order book, it surged by 135% year on year to 733 million last year. And we do think that it will cross the 1 billion mark this year itself, as the construction contracts are being tendered out, and after the main contractors flow through the contract to M&E players. And we think that Everglory is one major beneficiary of this trend. Yeah, so moving on to BRC Asia, they are the biggest steel rebar provider in Singapore. They have a 60% market share in steel rebar. So for those who are unsure, steel rebar is being used in the core and shell of the buildings, as well as infrastructure itself. For example, your road, your ceiling, your walls, your floors itself, those need steel rebar within them in order to support the structure itself. Yeah, so BRC Asia has a 60% market share in Singapore's construction space. So as you can see, the red color line in this chart itself represents BRC Asia's PATMI itself, which is the profits. And then the blue color line shows the amount of steel tonnage which they delivered out. So as you can see, there's a very strong correlation of this, of their profits and the volume which they ship out. And we do think that going forward for this year itself, the delivery volumes can expand by more than 30% this year, because as the construction projects progress, we do think that this will drive volumes for BRC Asia itself. For some context, over the past 2 years, 2024 and 2025 itself, the amount of contracts being tendered out is 60% higher than the past 20-year average. Yeah, so 2024 and 2025, the amount of contracts being tendered out is about 50 billion per year. But the 20-year average is only 30 billion. Yeah, so as you can see, with so much contracts being awarded out, the construction companies will have to execute on these projects. So these projects can be like HDB BTO, your MRT LTA line expansion, your healthcare facilities, your mixed developments, and most recently Changi Airport Terminal 5, which BRC Asia has already won a $570 million contract. So as these projects gets executed itself, we do think that this is a major tailwind for BRC Asia. Yeah, so for Pan United, a very similar story. Pan United has a 40% market share in ready-mix concrete. So this ready-mix concrete is also used in conjunction with the steel rebar, as mentioned earlier, in order to form your structures in the building itself. Yeah, so for Pan United, in this chart itself, the red color line shows the Pan United's profit itself. The blue color line shows the amount of ready-mix concrete which we estimate that Pan United has delivered out. So there's also a very strong correlation, as can be seen. And we do think that going forward for this year itself, there can be a volume expansion of more than 15% as the construction projects get executed, as mentioned earlier. Yeah, so So we see a very strong trend, especially in January itself. The industry ready-mix concrete volume spiked up by 28% year on year. So we do think that this trend can continue for this year itself as the construction contracts are progressed. Yeah, so for Pan United, we have a buy rating as well, target price 1.73. Yeah, so I think that's all from my end. I'll hand over the time to Hashim. Thanks.
Hi everyone. Yep, so I'll be going through a few small mid-cap stocks. First one is China Aviation Oil. So for background, China Aviation Oil, they are importer of jet fuel, where they import from overseas and supply to majority of the airports in China. And they also do jet fuel trading. One of the key upside we see from China Aviation Oil, it's their Shanghai Pudong International Airport, in which they own a 33% equity stake. So why we like China Aviation Oil? Firstly, currently Shanghai Pudong International Airport is contributing close to 50% to earnings for China Aviation Oil, and it's in the process of expanding. So if you look at the chart, you can see the blue line. The blue line indicates the passenger throughput. Currently, passenger throughput is above pre-COVID levels already, and it's actually above current capacity. And Shanghai Pudong International Airport is expanding by building Terminal 3. So that has an increase in passenger throughput by about 50 million or 62%. So this is very significant. If you look at the chart, you can see that there's a 62.5% increase in passenger capacity, which will translate to more refueling, and that will translate to greater contribution to earnings from Shanghai Pudong International Airport. The second reason why we like them, currently with the ongoing war, there has been a major impact on the airline sector. What we know is that Chinese carriers have access to Russian airspace, but North American and European air carriers do not have the same access. So for flights that's flying from Asia to Europe, they typically stop at the Gulf states, so Middle East, but currently they are being rerouted to Asia. And one of the key stopovers is China. So since China did not have the same ban on European airspace, Russia allows them to fly over their Russian airspace, and this reduces the time taken for them to go to Europe by 1 to 3 hours. And this is significant. What we've observed is currently bookings have increased close to 20% for flights that's going to Europe, and prices have tripled for economy class flights. And we think this monopoly will allow for demand to Europe to continue to increase, which would directly support China Aviation Oil, since they are the ones who are doing refueling for majority of the airports. So lastly, why we like China Aviation Oil. No one can ignore the fact that jet fuel prices have increased. Crude oil prices have also increased. But what China Aviation Oil is trying to do, they are trying to diversify their procurement of jet fuel. So historically, they procured jet fuel from Northeast Asia, so Japan, South Korea, and Taiwan. But now they are trying to diversify it. They haven't told us where exactly, but if we were to look at regional price differences in jet fuel, if China Aviation Oil were to procure jet fuel from North America, for example, that would allow them to save on jet fuel costs by at least $30 per barrel. And given the scale of China Aviation Oil, they're going to be buying jet fuel in bulk, so they are also going to be getting discounts. So this will be something that benefit China Aviation Oil. And all of this is only important if there is continued demand for air travel. So what the Chinese government is doing, they are providing support to the Chinese to the air travel sector in China by providing cash subsidies as well as tax exemption. So we think this would allow the air travel demand in China to be buoyant, and that would ultimately support Chinese carriers and China Aviation Oil. So we have a buy on China Aviation Oil at a TP of $2.53. So next company that we like, CNMC. So this is for background, what they do, they are a mining company. Majority of their revenue comes from gold, but also from zinc, lead, as well as silver. So one of the things about gold miners, we've seen how gold prices have been going up and down in recent weeks, but that's something that is out of the gold miners' control. What's under their control is costs of their production. And what we can see from the graph here, the blue line indicates the spot price for gold, and the green line indicates the price at which CNMC sells their gold for. So you can see that prices have been in tandem with gold price. But when you look at the red line, it has been more or less stable. So all-in costs, so what this means is the cost of operating a gold mine plus non-recurring costs. It only increased about 5.3% from 2023 to 2025. So why we think this is significant? This is a period where CNMC was rapidly expanding. What they were trying to do, they were trying to expand their carbon in leach processing facility. They were also trying to do exploration, and all of these added to their all-in costs. But you can see that it's largely stable. Main reason is because their volume has increased. So their all-in cost is reported as a cost per ounce, and this has allowed them to keep their costs low. And this is one of the main reasons we like them. They have a strong operating leverage. So apart from this, second reason we like them, their ore grade has improved greatly, about 21% compared to 2015. One of the main reasons for it, CNMC is shifting from open pit mining more towards underground mining. Underground mining, the ore grade tends to be better. So what this means is that, say every day CNMC is processing 800 tons of gold ore. They were only able to get 1.4 grams. But now, because of their shift towards underground mining, they are getting 1.7 grams. So it's more gold for the same amount of volume that's being processed. And lastly, why we like them? They are actively increasing their production. So their second underground Soko gold mining facility will be up by end 2026. And they're also exploring vertical shaft mining. So this is something that's in the books, which we think will contribute to their production from 2027 onwards. So ultimately, why we like them, yes, gold price can be uncertain. It's very exposed to macroeconomic factors. But something that is under their control is cost. And they have proven to us that cost is something that they can keep under control. And we think that even if costs were to fall to, say, 2023 levels, there is still a strong margin for them to support, continue to grow their earnings. And for that reason, we have a buy on them with a target price of $2.34. So last company that we like, Nordic Group. So for background, Nordic Group is an industrial services player. So they have diversified businesses across sectors. Some of the main businesses they have, firstly, is system integration. Secondly, defense. So majority of the shooting ranges in Singapore, it's being built by Nordic Group, and it's also being maintained by Nordic Group. So one of the main things about Nordic Group is their customers. So what we can see from this graph, the blue bar shows us their contracts won as of July last year. And then the orange graph shows us the contracts won as of December. You can see the big jump across sectors. So this shows that their customers are spending more. And if their customers spend more, Nordic benefits because they are the ones who are bidding for these projects. With the exception of clean room, air and water, if you see the graph, clean room, air and water already won $25 million in contracts in July. So once they're able to deliver on this, they would be able to bid for more projects and increase their order book. Apart from their current contracts won, they have a sales pipeline of over $300 million, and this is mainly in defense, which is one of their key subsidiaries. So one example I can give you is their upcoming project where Paya Lebar Air Base is being shifted to Changi and Tengah. This is a huge project, and Nordic Group has the capability because they acquired a fuel subsidiary called Avon. Another project that I can highlight will be the multi-mission range complex 2, which is also something that Nordic Group is or will be bidding for. So apart from their sales pipeline, another reason why we like them is their long-term recurring revenue. So one key highlight for them will be their shipping sector. They are the ones who are installing control panels for majority of tankers that we observe. So they've installed these control panels for about 1,000 tankers already. So why we think this is a long-term recurring revenue for them? A lifespan of a ship is about 20 years. And the control panel for a ship, it's going to be constantly upgraded. You need to have spare parts replacement, and that's going to be in the hundreds of thousands of dollars. So Nordic Group has secured this source of revenue for decades, and we think that's something that other industrial services players do not have. The last reason we like them, they are very acquisitive. They are kind of a one-stop shop currently. And if you look at their customers, one of their key customers is Micron. They have won Micron even though they are of a smaller scale. And that's not because they have underbid their customers or anything. You can see that since inception, their gross profit margin has been above 20%. So they're bidding healthily for projects, they're winning projects, and they're being chosen because of their capability. And we think this is what differentiates Nordic from other industrial services player in the sector. So for that reason, we really like Nordic, and we have a buy on them at 63 cents. So with that, I'll pass on to Paul.
So thanks, Hashim. So not easy to win the lucky draw. You got to listen to all of us. So the next one we have just a few more small cap is Geo Energy. So we initiated this about a year ago. It's up about 60%, which is actually still underperforming. I mean, some of these small cap stocks have doubled, tripled. So hopefully we'll reach there. The title is going for trifecta. So trifecta in horse racing means you win first, second, third. Like buy Toto, you win first, second, third. So that's what we are trying to get. So the first reason why the horse can run is because coal prices is starting to rebound about 25%. And then they are building this, I think I mentioned before, that they're building this $190 million road, and this will double their production. So this is the second winning number or horse number. And then once this road is completed, it's about 80%, then you will get new revenue streams. It's not just a coal miner, it also becomes an infrastructure because they can charge people for using the road and also the jetty. The next one is Q&M Dental. If you do not know, just walk around, you probably see one of so it's a dentist. So what is happening right now is they raised 130 million bond, and they are going for very aggressive, most aggressive acquisitions ever. Of course, acquisitions is, it's a mixed bag. I'm also not a big fan of acquisition. We all prefer organic growth. But these acquisitions can boost earnings by 80% or earnings per share, so the PE can drop a lot. And there's 3 big acquisitions pending. So what is different in these acquisitions is that they tell the seller, okay, I give you shares, but you cannot sell for 15 years. 15 days, you cannot take it, right? I mean, like 15 years. So whoever sells to them really have to stay with the company and make sure this thing is built. And they will also issue the shares at 70 cents. Of course, right now it's I think 60 or 55. So whoever comes in and buy, really, there is really a merger element right now. You come in, you cannot just take and then sell your company and then just walk home and have a good time partying. So there's a big difference right now with the way they're doing the mergers and acquisitions. And there's a profit guarantee for at least 8 years. And if this profit guarantee hits, there's like 14% growth. So the M&A now is structured very, very carefully. Not to say it wasn't structured so well, but and then they are going to do this across Asia. So if this happens, we have actually a target price of 95 cents. How we did it is very complex. No, we just take earnings times 25 times PE. But because the acquisitions hasn't been completed, so our target price is 71. And once this is done, because you're going to get a big jump in earnings. So that's how we got like 95. But right now we are assigning like a 50% probability. The next one is Oiltek. We initiated this, I think, almost 2 years ago almost. So this stock has been up 16 times. Or 16 bagger. So probably this is probably one of the best performing mid-cap stocks in Singapore. So what has happened is that SAF, for those who don't know, is called Sustainable Aviation Fuel. If you still don't understand, which most of you don't, it's like you're using used cooking oil, and then you fry, and then you take, and then just put it into the jet plane. Don't worry, SIA said this is safe. They will blend at least 1% of SAF into your plane. They say it's safe, so don't worry about it again. Let me just repeat. But anyway, because of this war, jet fuel prices has doubled from about $100 to $200. And there's a lot of demand now because they're taking all this from palm oil waste. So all the waste oil, when you mill the oil, you squeeze all the oil, there's a lot of waste. So they're using this because it's sustainable, renewable. And what is happening globally is that what happened was they won a big contract. This will bring their order book 5 times. We think the earnings will triple to 150 million by 2027 because it only starts at the end of this year. But we don't think this is the only one because SAF demand is spiking up. You can do the numbers of 2 and then 6 times. So what's happening is that there's like a 50% growth in SAF globally. Every country will probably need to build their own because they can't rely on the Middle East. If you all saw the map, which I think nobody can remember, but the other thing is that this is a very asset-light business. The ROE is about 40%. Cash is 100 million. It's because they don't have factories, they outsource, so they get someone else to do the heavy work, the steel manufacturing. They are like designer, they conceptualize it, they get the contract, and they will help fund it and and run, project manage it. So the last stock would be IX. The last time I talked about this, so I think some lady scolded me. I hope she's not around. Okay, but anyway, we covered this before, and this is a drug company. So it is a very brutal industry because this one is they really have to spend a lot on R&D. So we initiated coverage yesterday. We call it the year of the unicorn, not year of the horse, because unicorn means the market cap can hit 1 billion. Our target price is $1. Yeah, you don't have to check. The stock was only 20 cents. Maybe now it's about 30 cents. So we are very aggressive on our view on this stock. So let me just explain a little bit. So what they do is wafer-rich sublingual. The technology is called wafer-rich. It is sublingual because you put it under the tongue, not because it tastes good, but because it can go faster into your bloodstream rather than you swallow it or rather than someone injecting it. This is not a new company. It's been around for almost 10 years. So they have been really throwing money, almost hundreds of millions in developing this drug. And what they did was point number 3 is they got phase 2 US FDA. So even phase 2 is already a big achievement for a small company. They got it in 2019. 2021, they licensed it to Selos. That deal was actually worth almost 200 million US. But like we mentioned before, and the only thing that the only value add I gave management was the name was called C and the name was loss. So C and then loss. So obviously this company went under. And then because of that, they had to terminate the deal in March. So this company at that time was a 300 million market cap. They had 90 over million cash. So it was good, and management thought, okay, I got this deal on, but because of pandemic, they failed in some studies, C loss, again, C and loss, and then they had to terminate. So this company had to restart everything. By the way, that's the plant in Australia, in case you want to know. Okay, so anyway, my last slide. So why we like it is because what happened was, so they got this drug called Wafermin. So let me explain what Wafermin is. So Wafermin is the delivery of ketamine on the MDA receptor. I still don't understand. But anyway, what it does is that if you do have a pain in your finger, the pain will go to your spine and then go to your brain. But what happens is that this will block the pain signals up to the brain. It's called NMD, okay, but anyway, nobody understands that. But what we're just trying to say is that they got a big windfall in February, only last month, or 1.5 months ago, from the US Department of Defense, or you call it Department of War. So basically, the US government told them, here, I give you 41 million, This is not a contract to build. This is just virtually almost like free money. You give it to me, I take the money, thank you very much, and I go develop a drug, a phase 3 trials. And then once I get that drug, it is mine. So because the government wants their drug so badly that they said, I'll give you 40 million, you fund it, and you develop it, get a phase 3 FDA, and then once you're done, most likely you buy. I'm not going to spend 40 million and then say you're not going to buy it. But this will take time. The results of it will probably be first quarter 28. But anyway, in the meantime, the Department of Defense is also buying it for battlefield use. You don't have to take a guess where the battlefield is, but to show, so for us it's very critical because it's a testament to the technology, and also the US government is not only funding you, but also buying from you, and this is for military use. So we think also that the military will also help them get the US FDA trials. So you can imagine if you're meeting with the FDA and then there's a soldier behind or colonel general, what is the FDA going to say? Say, no, you cannot make it. Okay, but anyway. So the other thing is that so we think there are 3 ways that they can monetize this wafer min. So they can, of course, commercialize it once it's completed, just sell it. They can out-license it, like what they did on the CLOS deal. Or we think another possibility is a trade sale, because there is a competitor called Vertex, which has a similar pain drug, but theirs is at the pain receptor. That means, don't know when you cut your finger at that point. So it may not be that effective and may not be so fast. There's a lot more things about running out of time. So this is not the only trigger for the share price. The other thing is compound pharmacy, which 99% don't know. But in the US, you can actually sell drugs through compound pharmacy. That means you don't have to get FDA approval so long as a doctor is willing to verify it. So there is a second path that they're trying to commercialize the 40 over other drugs that they have. And we think the earnings will start to come in 2020, FY28 onwards. And then they are working with an important partner that will help them manufacture and also help them distribute these drugs. And the last part at the bottom here is just like any drug development company, the key is the timelines. So you can watch out for some of these events happening that can hopefully help bring the share price higher than what happened on Friday. But anyway, okay, so let me move on to the last part. We will review our absolute model portfolio. So in our model portfolio, we took out Singtel and we added Sembcorp Industries. So let me just cut short why we like Sembcorp Industries now. So we think there are 3 key share price drivers for Sembcorp Industries. So number 1, because of what is happening, LNG prices shot up. They have a gas trading arm, so they do take gas and they sell to other gencos and they will benefit. Number 2, there is a big acquisition coming in Australia, and this will also boost the earnings. Probably they can close the deal by May or June. And the third reason is that they do have Indian renewables, and we think they probably can list this and maybe give some special dividends and so forth. So that's why we are much more optimistic on Sembcorp Industries. What did well for the portfolio is like Geo, commodities and semicon. So this is just a historical track record. If like we always mention, if the performance is not right, please look for all the analysts there. And also, again, the quote there is that, like any fund manager, so far the portfolio is surviving the war so far. Yeah. Anyway, this is my last slide, so don't worry, lucky draw is coming. So in a fog, we are not predicting, so we're trying to preserve capital, but we think the worst is over. We think the ceasefire will last and so forth. I won't mention it much more, but I think we all know the key theme is the build, and then Singapore is attractive and safe haven. Okay, yep, sorry to rush the last few moments. Again, thank you everyone we'll have a Q&A session, but on behalf of the research team, thanks so much for joining us, and we hope everyone have a good weekend, also a healthy year ahead. Thank you.
Hello. Yeah, thank you, Paul and the team. Right, now we'll invite the team up on stage for the Q&A session. Yep, so any physical questions, do raise your hand, let us know. Yep, any questions? Yeah, over. Yeah, then one more there.
I'm just wondering, for the Changi project Terminal 5, basically, you guys are all taking that project will continue into perpetuity, basically, whereas it's more of a one-off opportunity. when you're valuing these stocks. So what's your response to that, basically?
So sorry, I didn't really catch your question.
My question is, Terminal 5 projects basically a one-off opportunity and something which will have a big impact on the earnings over the next few years, but beyond that, it will just disappear, that number, in terms of the earnings.
Oh.
So how can you price the stocks of that just one project, basically?
Sorry, just to clarify, is that in relation to Frencken? Or?
No. That's for the construction companies, I think.
Or the entire semiconductor companies?
Entire construction.
So basically, he's asking on the Terminal 5 impact, because it's only a once-off project. How can it be a valuating point for a company's long-term prospect?
Okay, yeah. Thanks. Sorry, didn't really catch because of the audio issues. I think you got a very correct point in that Terminal 5 is more like a one-off kind of construction value in the sector itself. And this has been driving the growth prospects for many construction companies in the sector. I think going forward, beyond this construction of T5 itself, there will be other drivers as well. For example, as the Paya Lebar airfield gets moved away, they are also trying to build up that Paya Lebar airfield as well. So apart from Paya Lebar, there's also countermeasures for the rising sea levels. So they are building up the greater southern waterfront to counter these rising sea levels. So these are the medium to long-term projects. Yeah. So that's why we never really emphasize on all these projects, because they are the medium to long-term. But these are the kind of projects to look out for beyond Terminal 5. Yeah. Hope that gives some clarity. Thanks.
Yeah, we have one question over here first, and the one over there. Next.
Hi, I just noticed that in the past, I guess it could be Paul who actually talks a little bit about this company called Zixing. It's a very, very small cap, but it just seems to have been taken out of your radar. Is that correct?
We still like Zixing, just that we keep talking about it for so many, so we just try to change the flavor. So we still like it. It is. I think it's trading only like 4 or 5 times PE, and basically the story around Zixing is the ability to raise the fresh seafood. Number one. Number two is also the process. So the story is still intact. Just that we've been talking about it, and the analyst that covers it is not here today. So that's one of the reasons why we didn't. But we should be coming out with some updates, because the company just came out with updates. So we should. But there's no change in our view. We're still positive on it. The demand for food security, the industrialization of that sweet potato industry. I know it's weird to go China and nothing else to buy sweet potato, but we think the growth is extremely strong, and they have this big Hainan project that can replicate what they are already doing. So that's why there's a short-term and also long-term drivers. Yeah, thanks.
Sorry, I just asked about the AI issue. You have talked a lot and recommend a lot of company. But how about teller choice? Should I have to keep it? Because I bought it many, many years ago. I was not in Singapore for the past few years, so I didn't have any update on it.
Oh.
Teller choice.
Yeah. So telechoice, yeah, okay, hopefully not as long as the Singtel special discount. That was like 1993. But telechoice announced that they are bidding for something in a very big project in Johor Bahru. So if you're keeping it, I would keep it, because they hinted very strongly they're going to get a very big project there. And it's very rare for a company to come up and say that I'm announcing, not that I want to bid, that I'm going to bid for something huge. And you better have, my own view is you better have a very good chance of winning, because it can be very misleading, right? So for them to announce that I'm going to bid something, I'm just like hinting to you that I'm going to win something. So that's one interpretation. The project is in Malaysia, and they also mentioned that this could be a regional opportunity for them on data center infrastructure projects. Just that the liquidity is very thin, so that's why I don't really mention it so often. Yeah, just that, because the rest can have other companies. But we still like it a lot. Yeah, thanks. Yeah.
Right, thank you. There's one question over there. Okay, so along the meantime, while they're waiting, is there any question online that you want to take also? Any?
Hi, hello. So just a question in terms to the market valuation. So Warren Buffett's holding on to a lot of cash. The Benner cycle is saying 2026 is quite dangerous. The PB ratio of the S&P 500 is back to 2000 and 2022 level. What's your view on a potential market crash? Thank you.
Sorry, you're talking about overall market. Sorry if I missed it.
Yeah, overall US market.
So the market right now is trading about 15, 16 times PE, which is in line with line with the historical average. If you do some one standard deviation, that's to make it sound fancy, right? So you're talking probably 15, 16% upside. That means the top quartile. In terms of a market crash, that was the scenario that we were trying to paint. If the war extends, the war breaks out, you get the worst of everything. Like even in Singapore, diesel price already jumped $1 to $3. Who's going to eat this, or who's going to pay the bill for this? So, but inflation, like we mentioned, is not the only problem you're going to have. High inflation, you're going to have weak growth, and you're going to have, like we mentioned in the slide, industrial shutdown. So if this war really protracts, they start to attack Iranian infrastructure, then all bets are off because the whole global industrial complex can really shut down. Like we mentioned, within 1 week, Singapore already had 3 chemical plants shut down. So if this is like 3 months and 4 months, it will be very dire. That's why we had those macro scenarios, just to let people understand that it can be, but so far with the way, I guess, not to put some conspiracy on it, like China and US want this deal to happen, I mean, yeah, on just outside looking in. Yeah. Of course, nobody knows, I mean, yeah. Maybe he doesn't know himself. And you know, I'm going to try to spend my time trying to forecast what he's going to think next. Wow, it's like too tiring.
So one more question over here. Yeah.
Hi, hello. You're saying the interest rate are not going down. So what? Any problem with property counters? Those property shares, interest rate not going down. Because property counter have been going up most half price. The CDL from 4 to 9, the UL from 5 to 10. Then some of the property counter almost double. So if the interest rate not going down, the property counter to hold or to sell.
Yeah, so the property counters, they did retract at the start of the year. So over the past year, a lot of the company, like the property counters I mentioned, did like almost double. So since then, in light of possibly higher interest rates and more uncertainty, and possibly, in my opinion, I think it's also linked to the fact that the asset monetization might be much slower this year, from the fact that the investment, like buyers might avoid committing to any deals because of the uncertainty that's going on right now. So I think that is partially the factor that really impacted the property market and the shares of the property counters as well, along with the fact that the potential for higher interest rates also, so that will affect the sales also, like the property take-up rates and such. So I think that's the main reasons why the share price didn't really perform so well over the past few months, after the sharp rally of over 2 times over the past year, like in 2025. Yeah, thanks.
What's your view on Ascendas REIT? Should unit holders subscribe to their rights? That's number 1. And number 2, any thoughts on your old favorite, Paul, Raffles Medical?
Yeah, so for Ascendas REIT, they are using the funds to actually acquire some very accretive acquisitions, like one data center in Japan, as well as some logistic properties in Singapore. So all in all, I think, if I remember correctly, the deal is actually about 2% accretive. But in the near term, because of all the fundraising and like the private placement and as well as preferential offering, there might be a bit of overhang in the market because of all these new units in issue. But generally, my view is if you are an existing unit holder, I think you should subscribe to the rights, because otherwise you'll just be diluted from the fact that if you don't subscribe, then you're wasting on the opportunity and your position will be diluted. Yeah, I'll pass it over to Paul for Raffles Medical. Thanks.
Yeah, I think that's also, just to add on, that's the problem with sometimes some of these REITs. When you're celebrating the share price go up, then they do this placement. Wow, got to double down on the share price. Yeah, but anyway, Raffles Medical, actually I have a neutral call. yeah, we had a neutral call for some time. So for the hospital scene in Singapore, it is not positive. I think the insurance companies are pushing back. I think I did mention it probably in the last briefing. The insurance companies are pushing back. They are pushing back. It's already happened in Malaysia, but they are pushing back on the high medical bills and so forth. So, and secondly, of course, foreign tourism is. I mean, it's not about the healthcare cost. And when you come to Singapore, you got to stay at a hotel, a few hundred in ringgit pounds. It's probably like 1,000 ringgit just to stay in some not even central area. So, healthcare, medical tourism is also affected. So, for Raffles Medical, the way to outgrow the weakness in Singapore is really China. But China is really tough because all the best doctors are in the government hospitals. If you're a Chinese national, you go see this hospital so big, you only go to the government because they have all the best, at least perception-wise, is best doctors. So it will take time for them to really turn the China hospitals profitable, and then start to grow the whole group's earnings. Because most of the good doctors won't leave; they'll stay in the public sector, and then maybe on weekends they come spend 2 days and then do in Raffles Medical. Yeah. So we are very neutral. We are a bit more very cautious on the medical sector, hospitals. Yeah.
Right. So in view of time, we will have the last question over there.
Well, I'm so honored. Just wonder why Singtel is not in the recommended list. You mentioned something like telco services. The Singtel share has been escalating, but over the weekend, Friday, I think there's a dip. But Singtel has also diversified into new business opportunities, like the data centers and also the innovation of 5G arena. So can I have your view, please?
Yeah, sure. Thanks. Hope your luck continues into the lucky draw again. Yeah. So for Singtel, it's not that we don't like it. There's no change in our view. Like we mentioned, Singtel's earnings, right? If you look at the associates, you can say maybe 30-40% of their earnings or more, or at least 60-70. Sorry if I don't have the exact number, but maybe 60-70% of the earnings depend on emerging markets. That's what we mean. Depends on Indonesia, depends on India, depends on Thailand, and we are just worried that you get a bit of slowdown from that segment. But you are right, they are building a new 62 megawatt Tuas data center. I hope I impress you with my memory. But that will double their data center EBITDA earnings. So there is that growth, just that in the very near term, you are a bit cautious. And frankly speaking, Singtel share price is very correlated to Bharti Airtel's of India share price. Like, I think we did a chart before. It's almost so if Bharti Airtel share price struggle, then Singtel share price will technically should be struggling a bit too. Yeah. So it's just more of a near-term phenomena than outright not liking it.
All right. Thanks, Paul and the team, on a great sharing for Singapore session. Can we put a hand of applause together?
Thanks. Thank you, everyone, for attending. Yeah.
Yep. So next, we have our last segment before the